Hello, everyone. Welcome back to Simple Business Talk. I'm Emma, your host. I'm so happy you are here today.
Hi, Emma. Hi, listeners. It feels great to be back again. This is episode 4 already. We're really moving.
Yes, we are, and today's topic is very exciting. We are talking about stock market basics. The stock market has created more millionaires than any other wealth building tool in history, yet 45% of Americans don't own a single share of stock. Today, we're exploring why this powerful engine of wealth creation remains such a mystery to so many people.
That statistic really highlights the wealth gap in our country. What's keeping so many people from participating in the market?
Well, here's what's fascinating. Studies show it's not just about having money to invest. A recent survey found that 48% of non investors say they stay out of the market because they don't understand how it works.
Those numbers really paint a picture of missed opportunity, don't they? Especially when you consider the historical returns.
Let me share something that really drives this point home. If you had invested just $1,000 in the S&P 500 in 1970, it would be worth over $150,000 today, and that's through multiple recessions, market crashes, and global crises.
The power of compound returns over time is truly remarkable, though I imagine many people see those numbers and think it's too late to start.
You know what's interesting about that mindset? The best time to start investing was 20 years ago, but the second best time is always today. Let me explain why. The stock market has averaged about a 10% annual return over the past century.
That historical perspective really helps frame the opportunity. How did our modern stock market evolve from its early beginnings?
Oh, this is such a fascinating story. The Dutch East India Company created the first modern stock market in 1602. And here's why. They needed to fund these incredibly expensive ocean voyages. But no single merchant wanted to bear all the risk.
So they essentially invented risk sharing through public ownership.
Exactly right. And what's really interesting is how that same principle still applies today. When you buy stock in a company like Tesla or Amazon, you're sharing in both the risks and potential rewards of their business ventures.
Speaking of modern companies, how has technology changed the way people invest?
Well, here's what's revolutionary about today's market. Thanks to smartphones and apps, anyone can start investing with as little as $5. The barriers to entry have basically disappeared, but that accessibility comes with its own challenges.
Hmm, you're thinking about the gamification of trading through these new platforms?
Precisely. Let me share some concerning data. A recent study found that investors using trading apps check their portfolios an average of 7 times per day, leading to more frequent trading and often poorer returns.
That behavioral aspect of investing seems crucial to success. What strategies do successful investors use to stay disciplined?
Here's what research has consistently shown. The most successful investors follow 3 key principles. First, they diversify their investments across different sectors and companies. Second, they invest regularly regardless of market conditions. And third, they maintain a long-term perspective.
Those principles sound straightforward, but implementing them can be challenging. How do people actually put this into practice?
Let me break down a practical approach that's worked for millions of investors. Instead of trying to pick individual stocks, many people start with low-cost index funds that track the entire market. These funds provide instant diversification and have historically outperformed most actively managed investments.
The data supporting index investing is pretty compelling, isn't it?
Oh, you should see these numbers. Over the past 15 years, about 90% of active fund managers failed to beat their benchmark indexes. It really challenges the idea that you need to be a stock-picking genius to be successful in the market.
That's quite eye opening. What other misconceptions do people have about investing?
Here's a big one. Many people think you need a lot of money to start investing. But studies show that investors who start with small, regular contributions often end up with larger portfolios than those who wait to invest larger sums.
The power of consistent investing really adds up over time, doesn't it?
Let me share some numbers that illustrate this perfectly. Investing just $200 monthly over 30 years, assuming average market returns, would grow to over $400,000. It's not about timing the market, it's about time in the market.
Those long term results really highlight why starting early is so important.
And here's what makes this even more relevant today. With increased life expectancy, many people will spend 30 or more years in retirement. The stock market has historically been one of the best tools for building the wealth needed for such a long retirement.
That demographic trend really underscores the importance of understanding investing basics.
Absolutely right, and let me share one final thought that ties everything together. Successful investing isn't about getting rich quick or finding the next hot stock. It's about consistently applying proven principles over time and letting the power of compounding work its magic.
That's such a powerful way to frame it. Thank you for breaking down these complex concepts today.
You know what makes this topic so important? It's not just about making money, it's about creating financial security and independence. Understanding how the stock market works is becoming as essential as understanding how to read and write in today's world. Thank you all for listening to Simple Business Talk, part of Business Extrovert. Our next episode will be about marketing basics, how to attract customers the simple way.